Hi, and thanks for tuning in to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm speaking with Paul Kim, who's the CEO and co-founder of Simplify, an ETF issuer with over $2 billion in assets under management. Paul, thanks for joining me.
Nice to have a chance to talk to you today.
Another one of your fixed income ETFs that's caught my eye, Paul, is the Simplify Short-Term Treasury Future Strategy ETF, ticker symbol TUA, which has been attracting a bit of attention from investors as well. I saw assets under management are picking up pretty nicely there. If I'm not mistaken, this fund seeks to outperform the ICE US Treasury 7 to 10-year bond index. How does it do that?
I think the main concept is that you could get duration in different places. You could either get a straight up vanilla exposure in the belly of the curve that might get you roughly 10 years of duration, right? Or you could do sort of what very big asset management firms do often is concentrate via leverage, typically futures or swaps, but in our case, futures in a different part of the curve. So if you lever up the 2-year futures, which are a little less than 2 years each, you get roughly a 10-year duration, except you're doing it in the part of the curve that tends to be the most sensitive to Fed policy. So when the Fed starts easing, that part of the curve tends to move the fastest. So it's really, think of it as a futures sort of equivalent in ETF. People are using it to take a recession bet, right, to position their portfolios, take advantage of easing or pausing. And then we've also seen it paired with short treasury positions on the longer side of the curve as a steepener. So it's really a tool. The first two funds we talked about are yield tools, and this is really a duration on the curve tool.
That's really interesting. Now, obviously, Paul, you have a lot of interesting strategies, but they're actively managed. So how important is the judgment of your fund managers when it comes to managing the risk of these pretty complicated ETFs?
TUA is less. It's really, think of it as mostly a static futures portfolio. AgH is certainly active, but not much more active than a core plus strategy would be from a larger or other fixed income manager. And then high is T-bills plus a basket of options. So 100% of the portfolio are in T-bills, which have very little active discretion. And then a tiny fraction of it is in this basket of portfolio of options, which is definitely has discretion on it, but it's a systematic strategy. So it's really on the R&D of making sure we have the risk management and the sizing of those sales in place. And we'll constantly look at the market and constantly figure out if we could improve on the methodology, but it's a systematic, active strategy.
Finally, before I let you go, Paul, obviously you've been incredibly successful at growing your assets at Simplify, and especially in the current environment with money markets at 5%, how are you convincing investors to look at your fixed income products when they can easily get 5% in more straightforward products?
I think for those who want true risk-free rate, T-bills and sort of money market funds are some of the best ways to get it. But I think we've had a lot of success with advisors and asset allocators who are looking for whether it's cash tiering, right? Maybe half their cash is in something like a money market and the other half is working for extra yield or extra opportunities. We're also seeing it, like we discussed, in interesting things like pair trades, steepeners, and things like that. And ultimately, no matter what condition, I think income is evergreen, right? People need income, and especially in retirement. So five's great, but if you could stretch for 9.5 or 10 without adding a lot more risk, that may be better for a lot of people.
Well, we're going to have to leave it there. Paul, it's been a pleasure. Thanks for your time.
Thanks so much.